Lee Seung-ho spent his mandatory military service saving money, 20 million won, about $13,000. When he got out, he put it into the South Korean stock market. And inside his trading app, he tapped a small circle button that instantly unlocked 5 times leverage. According to Reuters, that 20 million won became nearly 300 million, a 15-fold return earned by a 24-year-old university student in a matter of months. Roughly the price of the sole apartment he was trying to buy, which is to say about 14 years of an average salary. Then his brokerage sold all of it, not because he asked, because a threshold broke, and the software did what software does. 4 weeks start to finish. He's now back in a studio apartment that Reuters describes as barely larger than a parking space. And here is the part that should bother you. He wasn't wrong. The same month Lee Seung-ho was liquidated, South Korea had the best performing stock market on earth, carried by 2 AI chip makers most of the world had barely thought about. So this video asks one question. Who ended up owning South Korea's AI boom? And why wasn't it the Koreans who bet on it? To answer that, we'll trace 3 things. How 2 companies became an entire stock market, the 30 days the machine turned on its owners, and who quietly took the other side. To understand what happened to him, you have to understand what was happening to the country. At the end of 2025, the KOSPI, South Korea's main index, closed at 4,214. It had risen 76% in a single year, its best year since 1999. Then 2026 began, and it kept going. On the 19th of June, the KOSPI hit an all-time high of 9,385, up 123% year-to-date in less than 6 months. The best performing major market in the world. For decades, analysts had a phrase for the way global investors valued Korean companies below their international peers. They called it the Korea discount. That summer, people started writing its obituary. And this was not a fringe. Reuters describes a $4.1 trillion stock market becoming the world's hottest and its most volatile. As for why so many young Koreans were in it, leveraged, that part isn't complicated, and it isn't really a story about greed. An apartment in Seoul costs, on average, around 14 years of salary. If you're 24, the ladder everyone tells you to climb has had its bottom rung sawn off. A trading app offering 5 to 1 isn't a casino exactly. It's the only ladder still visible. But a market that goes straight up is always leaning on something narrow. This one was leaning on 2 companies. Those 2 companies are Samsung Electronics and SK Hynix. And what they make is memory. For most of the last 30 years, memory was the least glamorous product in semiconductors. A commodity sold by the ton in a business famous for boom and bust. Then AI arrived and it turned out that the one component you cannot fake inside an AI accelerator is high bandwidth memory. HBM, get it wrong, and the fastest processor on earth sits idle, waiting for data. Nvidia needed it. And SK Hynix, a company that had come close to collapse 2 decades earlier, could make it better than anyone. So the money came. By late May, SK Hynix shares were up roughly 250% for the year. And on the 27th of May 2026, according to CNBC, SK Hynix crossed a market capitalization of $1 trillion. One company worth roughly a quarter of South Korea's entire stock market. Samsung had crossed the same line. So had Micron in the United States. Between them, Samsung and SK Hynix came to make up close to half the weight of the whole KOSPI. Now, here is the thing almost nobody wanted to say out loud that summer, and it matters for everything that follows. Memory is the most brutally cyclical business in semiconductors. Not occasionally, structurally. Demand spikes, prices spike, every manufacturer on the planet builds new capacity. Customers double order to guarantee supply. And then the capacity arrives, the double orders get cancelled, and the price collapses. That cycle has turned in every previous memory boom, without exception. Nobody knew when it would turn this time, but everybody who had worked in the industry knew that it would, which is worth holding on to, because the people who eventually sold into strength. While it was still going up, the rally was real. The problem was never what people were buying, it was how. What happened next was assembled in about 10 weeks, and almost all of it was legal, deliberate, and officially approved. In late April 2026, South Korean regulators changed the rules to permit something the market had never had: leveraged exchange-traded funds tied to a single stock. 2x funds, not on an index, but on Samsung, and on SK Hynix specifically. Part of the reasoning was to stop Korean money leaving for American markets, where products like that already existed. Within a month they were trading. At the same time, ordinary borrowing went vertical. According to the Korea Financial Investment Association, margin loan balances in the Korean stock market hit an all-time record of 38.6 trillion won on the 24th of June. Broader Bank of Korea data, which counts other forms of investor debt as well, had passed 60 trillion won at the end of May. And the brokerages were competing for that flow. Reuters found that Lee Sung-ho, a 24-year-old student borrowing at 5-1, had been upgraded to VIP client status. They sent him a free electric fan. Now hold two mechanical facts next to each other. A 2x leveraged fund has to sell into a falling market. That isn't a decision, it's how the fund maintains its ratio. And a margin account has to sell when its equity breaks the maintenance requirement. Also not a decision. The broker does it for you. Both are automatic. Both are triggered by price alone. And both of them sell the same two stocks. That structure only ever needed one thing to happen. It needed Samsung and SK Hynix to fall at the same time. On the 19th of June, the KOSPI set its record. SK Hynix closed at its own all-time high, 2,919,000 won, on the 22nd. Samsung peaked 3 days after that, and then it went the other way. Not once, repeatedly. Reuters reported the index plunging more than 10% several times in a matter of weeks. On the 8th of July, the KOSPI fell 5.35% in a single session, closing at 7,246, formerly a bear market, 24 days after an all-time high. And this is where the machine took over. Here is the loop. It's worth going slowly, because the striking thing about it is that nobody inside it makes a decision. A price falls. Somewhere, an account's equity drops below its maintenance requirement. The broker does not call to discuss it. It sells. At market. Often before the owner is even awake. That selling pushes the price down further, which breaks the next tier of accounts, which triggers the next round of selling. Nobody panics. Nobody capitulates. There is no moment of fear anywhere in that sequence. It's a settings file. On the 9th of July alone, according to the Korea Financial Investment Association, 142.2 billion won of retail positions were force sold in a single day. And the share of leveraged holdings being liquidated hit 10.2%, roughly 1 in 10, against a 6-month average of 2.1. This is the point at which Lee Sung-ho told Reuters, "I literally could not breathe." By the 20th of July, SK Hynix was down 39.6% from its high. Samsung, down almost 32%. But here's the thing about a forced sale. Someone has to be on the other side of it. Every share a machine sold in Seoul that month was bought by somebody. So who was buying? Who was? The answer starts a month earlier, and it isn't a conspiracy, it's an order book. According to Korea Exchange data, between the 16th of June and the 16th of July, through the top and into the collapse, Korean retail investors bought, on net, 13.2 trillion won of Samsung and 21 trillion won of SK Hynix. Over that exact same window, foreign investors sold, on net, 15.5 trillion won of Samsung and 21.9 trillion of SK Hynix. Retail bought, almost one for one, what foreigners sold. And I want to be careful here, because there's a lazy version of this story, and it's wrong. Nobody coordinated this. Foreign funds were reducing positions in a market that had doubled in 6 months, which is, unglamorously, what a portfolio does when a holding runs up 123%. Foreign ownership of both companies drifted toward historic lows over months, not days, and the dividing line was never nationality. Korean pension funds weren't forced to sell either. Unleveraged Korean individuals weren't forced to sell. The line ran between the people who could be forced and the people who couldn't. The state noticed. On the 16th of July, 2 months after approving them, Korean authorities banned new listings of single-stock leveraged ETFs. As In-ki Cho, a senior market strategist at the trading platform Exness, put it to Reuters, the FSS governor has already admitted these products were approved too hastily, so this is a correction of a known policy error. So the domestic engine didn't just stall, it was switched off, by the same government that had switched it on. And while that was happening in Seoul, SK Hynix was doing something extraordinary in New York. On the 10th of July 2026, in the middle of the crash, in the same week Korean retail accounts were being liquidated by the thousand. SK Hynix listed American depository receipts on the Nasdaq. The order book came in roughly 7 times oversubscribed. The shares priced at $149. They closed their first day at $168.01, up 13%, and the company raised $26.5 billion, the largest share sale ever completed in the United States by a foreign company, past Alibaba's $25 billion, a record that had stood for 12 years. Now hold that against the other number. At the peak, Korean investors had borrowed a record 38.6 trillion won to buy shares. At the exchange rate Reuters was using that month, that's about $26 billion. Almost exactly what SK Hynix raised in New York, in a day. One side borrowed it, the other side was handed it, and once the drawdown reached roughly 40%, the foreign money came back. Korea Exchange data shows foreign investors buying a net 4.6 trillion, won of Korean shares across 3 sessions in late July. Around 7 trillion won over 4 days. So, were they right? On the assets so far, yes. Global institutions paid up for SK Hynix at the exact moment its domestic shareholders were being sold out of it. But remember the cycle. Memory has never once escaped it. And a $1 trillion valuation, built on a 250% run, is a bet that this time is different. That bet is still open. Nobody in this story has been proven right yet. Which brings us to the answer. Ownership didn't move because one side was smarter. It moved because one side could be forced to sell, and the other one couldn't. Leverage doesn't decide who's right. It decides who is still holding the shares when the answer arrives. Being right isn't the same as surviving being right. And the part that sits worst is what Lee Seung-ho told Reuters he intends to do next. But I'm sticking to margin loans. He still wants an apartment in Seoul. He'd like to be married one day, he said. A son and a daughter. The ladder hasn't moved. So he's going back. Which leaves me with a question for you. If your broker could sell your entire position before you woke up, would you still take the leverage? Tell me below. I read them, Because here's what actually made Korea's leverage dangerous. It wasn't the size of it. It was that it was visible, and it could be called in 72 hours by a machine. The debt now financing the data centers themselves is neither. Nobody can margin call it, and almost nobody can see it. That's next. That's the global economy decoded. I'll see you in the next one.